Hi there, my name is Mei. Welcome back to our 1031 Exchange episode. In this episode, we're going to cover some strategy how to help primary resident homeowner. Ron?
Yes, in the Bay Area, many people have highly appreciated primary residences, way above the amount that you're allowed to keep tax-free. There is a strategy how we can combine 1031 with primary residences.
I also have a lot of clients, they are selling their primary residence. And since the market has jumped a lot and a lot of people have more than 500K capital gain on their primary residence, so they hesitate to sell because they don't want to pay a lot of tax on the gain. Is there a way for the primary resident homeowners to defer the tax or save tax when they sell primary residence?
So the answer is yes. Now, first thing to realize, give you just a little bit of background. When you sell a primary residence, you're under section what's called 121 of the tax code. That allows you, if you're single, to keep the first $250,000 worth of gain in the property. If you're married, you get to keep $500,000 worth of gain in the property. If your gain is more than that, you pay taxes. Note, it does not matter whether you go buy another primary residence or not. You'll pay taxes if your gain is more than that exemption. Now, the question is there a way to combine the 1031 exchange with the primary residence? And the answer is yes, there are two ways of doing that.
Great.
The first way to do it is, do you rent out any of your property today or have a home office? Do you already show that you have an ADU or you rent out the basement or you have a home office? If you are already declaring a percentage of your property as home office or rental property today, whatever percentage of the property you are currently declaring, that percentage of the sales price, you can do an exchange on. Now, the truth is though, most of us don't have home offices. Most of us don't have rental as part of our property. So there is one more thing you can do: move out. Turn your house into a rental for a year or two. Now, after you've been renting out the house for a year or two, that property is now an investment property. But more importantly, that house still qualifies also as your primary residence, because the definition there is that
you lived there 3 years within the last 5 years.
Actually, 2 out of the last 5 years.
Right.
2 out of the last 5 years you've lived in the property. So as long as you've rented out the property less than 3 years and you meet that criteria, you can take advantage of both tax rules at the same time. So you can sell the property for, let's just say, $2 million, pocket $500,000, assuming it's a married couple, and then do an exchange on the remaining $1.5 million. So it's a way to do the exchange and get your primary residence exemption. Now, note, this does not work for everybody. If you need the money from your house to go buy yourself a bigger house, it doesn't work.
Right.
But if you have the means to, or you have the means to buy the other property, or you already have another place to go live, this is a good solution for highly appreciated primary residences.
That's really helpful, because that's one major concern a lot of people have. Like, if I sell it, I have to pay so much tax. I just don't feel like I want to do that, and then they stuck at their house. So if they rent it out, and that they really have to only rent it out for 3 years or less, what if they just rent out for 1 year? Can they still do that?
Well, the tax code nor IRS give us an exact amount of time you need to rent the property for, so that's something you need to discuss with your accountant.
Okay.
Most accountants say 1 to 2 years. 2 years if you really want to be safe, but we don't have a specific amount of time that you have to per the tax code. It's whatever you and your accountant feel is enough to actually declare the property as investment real estate.
Okay, so take the example, if I sell my property for $2 million, I exempt for $500K, I don't pay tax on it. And then if I only want to buy another rental property for $1 million, I would pay the capital gain on that 500, right? So you split it into 3.
That's correct. Now, so that's the other thing to realize is, in doing this, you're doing an exchange on everything minus the exemption.
Okay.
So what you bought the property for, or what you spent for improvements, that doesn't factor into it. So if you, again, using those same numbers, you sell for $2 million, You're married, you get to pocket 500. You need to do an exchange on the remaining 1.5 to defer all of your taxes. If you only spend $1 million, you're going to pay tax on that $500,000 that you didn't spend on the replacement property.
Ron, this is great information for primary resident homeowners how to defer tax. And so we learned a lot today. And if you have any questions, don't hesitate to reach out to Ron.
Yes, my phone number is 408-483-1031. You're welcome to contact me anytime with questions, and hopefully I can help you in the future.
And if you have any comments, don't forget to leave on below and subscribe our YouTube channel, follow us on social media. See you next time.